Hey, how's it going? Bryant here. So I wrote down some preliminary stuff because as you can see, I screwed up a lot of this trying to explain this in real time. So I am basically doing this because it is an easy way out for me. So anyway, Bryant To Economics, we're going to talk about interest rates today, i.e. credit cards, student loan debts, mortgages, and savings, and so on and so forth. So what is interest? Well, interest is basically the time value of money. It is, and if it compounds, whatever. So basically the time value of money. As time goes on, money, go up. So $100 you lend it at 12% annually. At the end, if it's compounded annually, you'll get $112. So you put money in the bank, and in some magical place that gives you 12% interest, at the end of it, you'll get $112. So, and then it compounds. So at now, if it's $100 at 12% compounded monthly, typically what they'll do is they'll give you the interest rate annually as like an easy way to do the numbers. And compounded monthly, you'll get $112.68. You'll notice that you'll get that if it's compounded monthly, you'll get a little more than if it's compounded annually. Why? Because you divide 12% by 12 months, the amount of time that's amount of times it's compounded. Every month works out to be 1%. So $100, your first month, you get $101. Second month, you get $102.01 because the 1%, it's the previous month's entire balance or entire what you lent times 1%. So it's like 1.01, which is how it works out to 102.01. In third month, it's the same thing. It's that 1% times the interest on it. So 1%, if it's 1% interest, then that equals to, you use 1.01 to multiply it. And then it gives you the 103.03. And eventually, after the year, it's $112.68. So let's talk about loans, particularly like student loans. So let's say you borrow $100,000 at 5%. What happens? Let's say the first year you're going to owe $105,000 because it's 5%. So it's 100,000 times 1.05. Let's say during the first year, every month, you pay $500 a month into this loan. So over the year, you pay $6,000 into it. That means at the end of the year, you're left with $99,000, and I'm compounding annually to make it easy numbers. But if you compound it monthly, it's obviously more. At the end of the year, when you pay $6,000 into it, you're left with $99,000, right? Then you multiply that by the 1.05 because it's 5% interest. Your second year, you still owe more than you borrowed at $103,950. Then you pay $6,000 again. Then you're left with, at the end of the year before the interest rate kicks, $97,950. Then you have to multiply it again by 1.05 at 5% interest. And then you owe again more than you borrowed. Until at some point, the numbers go down, down, down. And at some point you break even, and then you start paying more into principal than interest. Why is this important? Because when you borrow money, and then you have to understand how interest rate affects you. And at the end of the day, for $100,000 borrowed, you might pay $87,000 in interest. I'm using an arbitrary number, depending on the interest rate. This is a hypothetical situation where you could be paying more. It's not exact to this. But the point is that when you borrow and you look at the math this way, just know from the go for the first few years or whatever it is, depending on the interest rate, how much you pay per month, this is how people have to start looking at loan payments, because whether it's a house or a mortgage or a car or credit cards, this is typically how it's calculated, and why even though you're paying it, you might owe more than you originally borrowed, because it's just math and numbers. So let's use a scenario with credit cards. Let's say you borrowed $1,000. Let's say you borrowed $3,000 for a laptop, like a really nice MacBook Pro or whatever. And then there's an annual interest of 20%. Annually. So long story short, if you keep borrowing this money, the 20, or let's make it 24% annually. That means in the first month, if it's 24% annual interest on a $3,000 laptop, that means it's 2% per month of interest. And then you borrow, you owe after the second month. So in America, I think there's a grace period of 25 days where you if you have a new purchase, you don't have a loan balance, they don't charge you interest. But let's say they do. And that's a discussion for another time, because I know if you pay off the statement every month in America, you're not going to get charged interest, I think, on credit cards, because I think that's a law. But assuming you keep a balance of $3,000 on it, then your $3,000, you're going to owe $3,060 at the end of the second month. So let's say you pay off $30 of $30 of it. So you pay off $30, and then you owe $3,030. Then the following month you will owe $30,096 the following month after. So as you can see, if you pay a really, really small amount that's lower than the interest, this is called negative amortization, your debt is going to balloon over time greater than you owe. So you're going to owe more money over time, more than you initially borrowed. So when you pay off debt or credit cards or whatever, you need to make sure that you pay off more than the interest that's being charged to you, so that your debt goes down. The goal is you want the debt to go down. This is what you want, a downward curve of your debt. You don't want the debt to keep spiraling up and up and up, so it becomes more and more over time. So that's my really quick rundown. It's not all encompassing of a bit of interest rate talk and student loans or credit cards or so on and so forth. If you have any questions or specific examples you want me to go through, let me know in the comments section. Always happy to make another video and see if there's anything I can share or help you guys with. Have a wonderful day.